Ask a professional who manages other people's money for their honest advice, and a shocking number of them say some version of the same boring thing: buy a low-cost index fund and go live your life. Let's talk about why the boring advice keeps winning. An index fund tracks a market index, like a broad stock market index, by holding all or most of the companies in it, sized in proportion to the index itself. Nobody's in the back room heroically picking winners. The fund just mirrors the market, sits back, and lets the market do its thing. Actively managed funds, where a human tries to beat the market, tend to charge more, often north of 0.5% to a full percent a year. Index funds skip the active picking, so they often charge a small fraction of that. Over decades, that fee gap compounds quietly in the background. A 1% difference on money growing for 30 years can eat a meaningful chunk of your total return, just from being a repeated annual toll instead of a one-time fee. A large, frequently cited body of research keeps finding the same thing: most actively managed funds underperform their benchmark index over long stretches, after fees. That doesn't mean nobody ever beats the market, it means reliably picking who will, in advance, has stumped even full-time professionals. Broad diversification and low fees are two things an investor can actually control, unlike future returns, which nobody controls no matter how confident they sound online. That's a big part of why index funds became such a common building block. What fits your specific goals and risk tolerance is worth a conversation with a licensed professional. This is educational content, not financial advice.